Alright, let's talk about what might be the most dangerous 10 days for silver prices this year. And no, I'm not being dramatic, okay, maybe a little dramatic, but the data actually backs this one up. So Chinese New Year kicks off on February 17, 2026, and the Chinese markets, the Shanghai Gold Exchange, the Shanghai Futures Exchange, they're all shutting down from February 15 through the 23rd. That's 9 full trading days where the world's largest physical silver buyer just goes dark. Gone. Off to celebrate the year of the fire horse, eating dumplings, lighting fireworks, doing everything except buying silver. And if you're a silver stacker like me, that should at least make you raise an eyebrow, because we saw exactly what happens when a major market goes on vacation just a few weeks ago. Remember Christmas? Not the presents and the eggnog part, the part where silver got absolutely demolished. On December 29th, silver crashed 11% in a single session. Some reports say it extended to 14% by the time London traders stumbled back to their desks. And why did it crash? Because holiday liquidity was roughly 40% lower than normal. 40%. That means the order book was thinner than my patience when someone tells me silver is just an industrial metal. The CME piled on margin hikes, 3 increases in just a few weeks, jacking up initial margin by over 25%, and leveraged traders got flushed out like it was a fire drill. Silver went from a record $84 down to the low 70s before anyone could even finish their turkey leftovers. Now here's where it gets really interesting. There's a Chinese billionaire named Bian Ximing, and this guy is not messing around. He made roughly $3 billion on gold longs over the past few years. $3 billion. With a B. And now? He's flipped bearish on silver. Through his brokerage, Zhongkai Futures, he's built what is reportedly the largest net short position in silver history on the Shanghai Futures Exchange, about 30,000 contracts, which translates to roughly 450 metric tons of silver, valued at around $300 million. He started stacking this short in late January, ramping up from 18,000 contracts to 28,000 in just 2 days. That's not tiptoeing into a trade, that's cannonballing into the deep end. And so far? He's sitting on a paper profit of roughly $288 million as silver has dropped over 16% from its peak of $121 an ounce. So yeah, this guy clearly thinks silver has more room to fall, and he's put his money, a lot of money, where his mouth is. Now let's look at what the broader market is telling us, because Bian Ximing isn't the only signal flashing yellow. The latest commitments of traders report, that's the COT data for the week ending February 3rd, shows that managed money net longs in silver collapsed 38% to just 4,491 contracts. That is a 23-month low. Translation: the big speculative money that was riding silver higher? They're heading for the exits. They're not even bothering to short it aggressively. Managed money short positions actually declined to about 7,682 contracts. This is pure I'm out, good luck everybody energy. Meanwhile, commercial traders, the banks and swap dealers, are sitting on a combined net short position of over 46,000 contracts on COMEX. So institutional money is positioned for downside, retail speculators are bailing, and we're about to enter a 9-day window where China, the biggest physical buyer on the planet, won't be placing a single order. If this is starting to sound familiar, it should. It's basically the same setup as the Christmas crash, except this time the absent market is even more important. China accounts for over half of global industrial silver demand. When their exchange is close, the buying pressure that has been supporting silver prices, especially at a time when Shanghai premiums over London hit record levels above $8 per ounce, just evaporates. And in thin markets, it doesn't take a lot of selling to move prices significantly. A few well-timed sell orders in the middle of the night, a margin hike here or there, and suddenly silver is having a very bad week. So, should you panic? Should you sell everything and hide under your bed with your silver bars? No. And here's why. The physical silver market is telling a completely different story than the paper market. COMEX registered silver inventory, the metal actually available for delivery, has dropped to about 107.7 million ounces. That covers only 14.2% of total outstanding futures. In January alone, 49.4 million ounces were pulled out of COMEX. In the first 5 days of February, another 19 million ounces were requested for delivery. The vaults are draining at an accelerating pace. And here's the kicker, March 2026 is the biggest delivery month of the year, and the first notice day is February 27th. That's just 3 days after Chinese markets reopen on the 24th. So anyone who is short silver on COMEX needs to either come up with physical metal or close their position, right as Chinese buyers come flooding back into the market after 9 days of pent-up demand. Let me put that another way. The bears might get their dip during the holiday window, and honestly, I'd say the odds are elevated that we see some downside volatility, maybe even a sharp move lower if someone decides to test the thin liquidity. But any dip is likely to be temporary, because the structural setup is overwhelmingly bullish. Physical inventories are at crisis levels. Chinese factories making solar panels, electric vehicles, and electronics are going to need to restock their silver after the break. China has designated silver as a strategic material for its green energy transition. And the March delivery crunch is going to force a reckoning between the paper price and the physical reality. Think of it like this: the holiday closure is like someone turning off the lights at a party for 10 minutes. Sure, some people might trip over the furniture, someone might knock over a lamp, and it'll be a little chaotic. But when the lights come back on, the party is still going. The DJ is still there, the snacks are still out, and everyone's going to keep dancing, probably even harder than before. So here's my honest take. If you're a long-term silver holder, this Chinese New Year window might get uncomfortable. Watch for volatility, watch for potential dips, and don't be surprised if you see some scary red candles on the chart. But don't let a temporary liquidity event shake you out of a position in a market where the fundamentals, real physical metal demand versus dwindling supply, have never been stronger. Bian Ximing might be a billionaire with a big short, but even billionaires can be wrong. And when March delivery rolls around and those COMEX vaults are running on fumes, we'll see who's really holding the cards. If you found this breakdown helpful and want to stay ahead of what's happening in the silver market, make sure to smash that like button, subscribe to the channel, and turn on notifications so you don't miss the next update. Whether silver dips during the holiday or rips higher on the reopening, you're going to want to be here for it. Until next time, keep stacking, stay informed, and remember, the shiny stuff always wins in the end.